Welcome to the Landlady Listens. The podcast where we talk all things real estate, development, and the mindset it takes to build your dream life.
Okay, hey guys, it's Landlady.
I'm your host, Meg Hayden, real estate broker, new construction expert, and a believer in making big visions into a reality. So if you're ready to build it, dream it, and live it, let's dive in. Hey guys, it is Meg Hayden with the Landlady Listens. I am so excited for today's guest. We have TJ Curran here from Go Rascal. We're going to talk about a lot of different loan opportunities and programs, but I'm your host, Meg Hayden. I am a commercial and residential real estate broker in Rhode Island and Massachusetts, specializing in development. And we're so happy you're here to listen and learn. And without further ado, hey TJ.
Hi, how are you?
Welcome back to the show, TJ.
Thanks. Yeah, friend of the pod. Yeah, repeat appearance.
Exactly. I know. Well, we were like, it's funny. It's almost been a year since you've been on the show, and you were like, I've learned so much. I've done so much. I've learned so much. And I was like, all right, you got to come back on the show. And so tell us like a little bit about, you had recently started, been in the industry forever lending, and you went from like managing and just doing residential, and now you're a broker. Talk to us a little bit about that.
Sure. So it's been a journey in a year. So I'm on my 23rd year of being a mortgage loan officer. I've never been in the broker world. So I've always been retail, which is basically a mortgage company or a bank. And mortgages are all risk-based, right? So the way you decide, most lenders decide what mortgage products they are going to offer is risk-based. So, the least risky, obviously they're going to, single-family residences with 20% down. Those are the least risky that people are going to live in. And then they get some stuff outside the box, investment properties with, 25, 30% down. And, sometimes some other stuff, government loans. But I never really delved into the world of investors. So investors with non-QM products. Non-QM basically means a little bit more risky. And because I'm a broker now, I have access to about 140 different pools of money, we'll call them, because some of them are banks, some of them are lenders, some of them, I have a channel that goes directly to Wall Street. And it really is a cheat code to being able to offer a client a wide swath of options, even if they think there aren't any. And I'll give you an example. So I have a client right now who's buying a condo hotel in New Hampshire.
Oh yeah, I'm so excited about this.
So for those that don't know, a condo hotel is typically it's some kind of resort that was converted to a hotel. And that means, and then they sell it to you. You'd be the owner, but the association then rents it to people when you're not there.
So the reason we talked about this is because I love skiing.
Sure.
A lot.
Yeah.
And I get the Epic Pass, and so whenever I go to look at where me and my kids are gonna ski, I go and pretty much look at like the cheapest place that weekend, but also with the most like amenities,
right?
Especially with the kids, like the pool, the hot tub, the indoor hot tub, outdoor hot tub, arcade, restaurant, the works, you know. And we were at Attitash, and I found this. It was a hotel condo on. It was literally like right at the base of the mountain. I mean, you had to go under the street at the base of the mountain, and I was like, "This is great." And we found it on Airbnb, and so it's really that, right? It's a hotel condo, and I never.
Sure.
And the reason we talked about it because I was like, I didn't even know that you I didn't even think of it as being a condo until you mentioned it the other
Right.
night.
Right. Yeah, there are people that own them, and it's basically you're right. It's basically like an Airbnb that an association runs, a condo association or management company will run it and rent it to people like yourself,
But there's like a legit
but there's a person who owns it.
hotel. So like you go
So
in,
there's usually amenities. Yeah.
you check in,
Right.
they give you a key, like it's like that,
Yeah, and
which is
usually there
great.
are hotel amenities like pool and sports club, or you can use, some of them have their own access to a mountain that you can ski on or whatever. And
I'm sure that like the condo fees have to be like astronomical.
so in
I'd
this one they were like
wonder.
$730 a month, which is
Yeah.
not too bad.
No.
Um,
Especially when you're getting that much, because a lot of times, like, I'll see condos and they're condos again, I'm like, I will be buying a ski
sure.
property at
Yeah.
some point. Maybe not a $700 expense each month for the condo hotel, even though it'd be great. However, I'll see a lot of condos and they don't have the amenities. Like, I'd be down for spending $700 a month for the amenities, but a lot of the times you're like, it's $800 for what?
So the one thing about this is I want to say they rent for like $700 a night. So
Not the one I was
so yeah, the
renting.
association I'm talking about rents for like $700 a night. So that's you're covering your
Great. One night.
right.
Boom.
You're like you rent it out for, let's call it 8 days, and you're probably more than breaking even, but a month. Uh, so some of the things to consider with that is, first of all, most lenders don't do it, but I'm able to do it because I have a few different outlets, and I actually, like everything else, there's trial and error. So I tried one outlet, and they did what's called a full review. So for those who are well versed in condos, um, basically there's a lot of things that go into a condo association.
It's a process.
It's a
Well,
process. So
because
yeah,
I mean, really, what you're doing is you're not only approving the person, you're
right,
approving the condo association. So
right,
you're approving two parties
right,
with a lot of people
and
on both
typically the
sides.
condo association is more difficult to approve than the person, because there's usually a board or a company that manages the condo association, and we look at, or all lenders look at. There's a questionnaire they fill out. Typically, there's a budget. There's bylaws. There's the master insurance policy, and if anything is lacking in the eyes of the lender or the underwriter, then those things need to be changed and amended, and sometimes it's difficult to get that done for a condo association. Now, if you currently live in a condo, you live in one, right? These are still the things that you need to kind of keep track of. Like, does one
Absolutely.
person own multiple units,
Yeah,
right?
that's part of the questionnaire. Like,
Yeah,
they ask like, how many are owner occupied,
right,
how many are investment,
right,
and then they look at the budget. So I always say, even like for anyone who's looking to purchase a condo, the biggest questions that you have to ask the agent and the condo association are there any assessments that are coming up?
right,
And an assessment is like, hey, by the way, we have to do all the roofs for all of the units.
right.
And, maybe it's a small condo, so it's like, oh, whatever, it's $20,000. But if it's a huge one, I mean, you're talking about huge expenses, or the
Yeah,
vinyl, or the windows, or
yeah,
whatever is needed, or the sewer, water lines, whatever. So
yeah.
those are things that definitely have to ask when you are purchasing. My second question is always, is there any pending lawsuits?
Litigation. Yeah,
Yeah, litigations.
right.
So those are two of the things that I always make sure. And then also, when you're looking at budgets for the association,
Yeah,
that's one of the biggest things too. And FHA, right, is typically like a guideline that makes sure that their criteria for the budget is good. And
This
so,
was a Fannie. They go by Fannie Mae guidelines, but
right,
yeah, right,
right, but it's always like, if you're doing FHA or Fannie Mae
right,
conventional, it's always important to think like, okay, our budget is approvable
right.
by these government bank or
Yeah,
government loans.
right.
Um,
And typical rule of thumb is 10%. You want to have 10% budget reserves. Reserves. It has to be a line item in the budget. And so the condo hotel that was working on, they didn't have any reserves in their budget as a line item, and they had an assessment where it's like they were redoing sidewalks, roofs, landscaping. Like it was bananas, but I still found someone who would finance it.
Mhm.
So again, being a broker and having a lot of different options, sometimes you're on the phone all day,
Trying to
trying to
find.
figure out who'll do it because there's a lot of wrinkles, right, to these deals. And being a condo hotel, a lot of outlets don't want to touch it to begin with. So there's if anything, we want to know the wrinkles up front, and we can kind of deal with them as they come. Um, and there's even lenders who will do condo hotels as DSCR, right? So DSCR is
Oh
debt
yeah, we were
service
talking
ratio.
about that. Yeah, so
Yeah.
talk to us a little bit about
So
that.
debt service ratio, if you're looking to get into Airbnbs or rentals or even a condo hotel, debt service ratio
I
is,
just love that condo hotel.
yeah, it's a good option because it doesn't take into consideration your debt ratio or even your income, or even you don't even really have to have a job. If you have good enough credit to qualify, you have the required down payment, whatever that may be. Typically, 15% is the lowest I've seen, but you really want to put down 20% because the rates aren't really attractive at 15%. And then the rents have to cover the mortgage payment, the principal, interest, taxes, and insurance. Now, in a condo hotel, right, or any kind of short-term rental, Airbnb, what they'll do is they'll look at what it rents for, and then they'll say, all right, typically in this area, you have 48% vacancy, which means it's rented 52% of the time, right? So 52%, rough math, you
Times $700
right,
per night.
right. So
Right.
16 days by $700 is what you're gonna, gross, and that would typically, I would imagine, unless you're buying $1 million condo, that would cover the what the principal, interest, taxes, and insurance is. So a lot of times, especially in this area,
However, one thing I do want to mention
sure.
is when you're doing that, make sure you're leaving in, your cap expenses, your operating
So
expenses,
right.
and your 8% management fee, unless that's already kind of like cooked into the books for this like condo hotel. I would be interested actually to see like what each place rents for, and also like do you like are those condos like for sale online, like they're just like normal residential,
There
or
was
are
a
they commercial? I mean,
there was a
I don't know.
listing agent who had it listed. It was on like Zillow, Redfin, like probably her website too. I don't remember what company she worked for, but yeah. So it was listed, and it was listed. It was on the market for 190 days. Like these things sit because it is difficult to get financing for them
And it's also, I mean, but it's kind of a great option if the numbers make
if the
sense.
numbers make sense, right? So because a lot of people in the second home market, they don't want anyone else in their place, right? They're not typically thinking about renting it. They're going to use it for the ski season, and then it's probably going to sit vacant for the summertime or whatever. Who knows? Maybe they'll have a long term renter in the summertime. But my point is you can use these DSCR loans for short term rental properties, be Airbnbs and whatnot. They're I know in this area they're typically, you apply that logic or the eligibility to multifamilies, right? So multifamilies, it's a great way to get into the multifamily game, especially if you're an investor who's aggressive on your tax returns and you claim all the deductions, or you already have a bunch of properties. It's a good way to add properties by just using the debt service ratio. And again, to Megan's point, your debt service ratio is not all of the things that you should be factoring to understand if it's a good
Yeah.
deal or not. There are other things at play, like your cap rate and everything else.
But I just think a lot of people think DSCR is just multis. And
Correct,
so that's
but
why
it's
it's
not.
cool
Right.
to like when we were talking the other night, it was like, oh, okay, cool. So you can do short term rentals with a DSCR loan.
Mhm.
You can do your condo hotel with your DSCR loan, and anything else that is creating income in terms of real estate. Um, and I think it's important because I feel as if the multifamily market is very difficult to make money off of at the current state
In this area, for
in
sure.
this
Yeah.
area. If you are, yeah, unless you're taking on like a full gut rehab or putting in a lot of work, you're burring it.
Right.
um but I think that this was like it's a kind of I don't know, it kind of like opened my eyes to just say, "Oh, okay, like so I could invest in my ski chalet."
Right. But even Burr, like a Burr is typically your hard money up front, but you can DSCR out of that and do a cash out refinance with DSCR loan. And that way you're not in that hard money, double digit interest rate environment. I just did a two family in New Hampshire and the rate was in the sixes. You know what I mean? So you were talking
For a DSCR loan?
DSCR loan. So it was
Wow.
DSCR, right? 2 unit. They put 25% down,
Mhm.
and the rate was like 6.875. Now in New Hampshire, you are allowed prepayment penalty, so there was a prepayment penalty on it. But
So
if
talk about prepayment penalties
excuse
quickly
me,
for someone who
yeah,
doesn't
so
know.
prepayment penalty just means typically uh, to really see an improvement in rate that's markedly worth it. You want to do a 3 year prepayment penalty. So what that means is you can't sell or refinance the property in the first 3 years, and if you do, you incur a penalty. It depends, but it's typically like 1% of uh, the remaining loan amount.
Mm.
So on a $400,000, that'd be $4,000.
Yeah. But it's something important to note when you are doing like a private lending or seller financing
Right.
that little tidbit, make sure you run it into Claude and say, is there any prepayment
Right.
penalty? Because sometimes like it's great. I mean, it's fine if it, well, you know, you usually don't want it in there, and and you can negotiate that.
So
And a lot of people they want to be able to say, okay, I know I have my $100,000 in here for 8% for the next 3 years. Cool.
right.
Versus in a year and a half, I'm going to have to find where I'm going to put my money next. And so that's why they offer that's why they pull up the
Right, and it's
penalties.
the same exact thing for lenders, right? So they know because they know the money's going to be there for the next 3 years, they'll offer better interest rates. For investors, a prepayment penalty can be a tool to access a good interest rate for 30 years by making sure you don't change it in 3 years. But um, you want to make sure the prepayment penalty is not on the loan until after you burr the property, right? Until buy
Ruh, ruh,
renovate.
ruh, ruh,
Yeah, yeah, renovate,
ruh. Renovate,
um,
rehab,
rehab,
rent.
refinance. So, those are, but it can be a tool again. Uh, Without a prepayment penalty, the rate would have been probably in the mid sevens for these investors. But now they're on a 30-year fix for 6.75, and they're buying and holding. They're not flipping these properties, right? So if you are doing a burr, coming out of the burr, prepayment penalty is a good tool to fix your costs lower than what you
But
would.
you have programs though that you can burr, right? You have
Yeah, so we have fix and flip programs. So in fairness to the other hard money lenders out there, it's you want to be experienced. They're for really for only experienced lenders. You can do for our first time, buyers that
flipper.
flippers, right? Um, but typically the rate is not much better. The rate for through a broker is not much better than hard money, and there's more paperwork, right? So they're looking at your credit, they're looking at your income.
It's a
Sometimes,
bank.
right? So yeah, it's an institution
But I
where
think I think a lot of times people like when they first get started, they maybe they don't know
sure,
like what hard money lending is.
right,
And I mean, I don't even like calling it hard money lending anymore because I feel like it has a connotation, but it's like private lending.
yeah.
And
Hard
so,
money, hard money seems like the mob is involved somehow, right?
yeah.
Yeah. So
Yeah.
so private lending, and if someone that's listening to this podcast has a question about private lending and they want to start with fix and holds or the Burr process, I'm happy to introduce them to a private lender
Yeah,
because
we've got a lot
yeah,
between the
yeah,
two of us.
right.
Yeah.
And the reason is because it's somewhat self-serving because I know once you buy it through hard money and you fix it up, if you're going to refinance out of it, you'll probably work with me because brokers are going to have the lowest rates coming out of that on DSCR, and I'm a broker.
Well, and that's something that we had talked about before too, was I remember you coming to me and you're like, "Hey, listen, if you have a seller who's going to do seller financing,
Right.
you're like, I'm willing to like vet
Yeah.
these people,
Right.
right? Pull their credit,
Yeah.
income, what debts they have,
Yeah.
so that on the back end, whatever, 2-3 years later, that I'm getting the refinance on the back end,
Sure.
which I feel like is such a value add for my clients to be
Right.
able to say, hey, by the way, I have a lender who's going to make sure that like, because seller financing, like some of these people don't even ask who you are.
Right. Well,
Like
the other thing is
it's like actually great. I'm like, wait a second, like
right.
you don't know me or anyone from
Right.
like a hole in the wall.
Right. Yeah. So for realtors to protect your sellers who are willing to do seller financing, yeah, I'm willing to vet the buyers. And again, it's helpful for you and it's helpful for your client that's selling the property. But for me, it's a pool of people who want to buy houses, and only one's going to be able to buy this house. And hopefully, I do end up with the refinance down the road. But the rest of the people are most likely going to buy somewhere else. So
Right.
now I have those pre-approvals in my pocket where they're going to be hopefully buyers of a different property. So it's it's a give kind of
It's a win-win
give to
for
receive. Yeah,
everyone.
yeah,
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 yeah.
exactly.
Awesome. What else have you been like? Anything else that you were like, wow, this is kind of
So you know
interesting?
what we have coming down the pike, which is
Tell
yeah.
us.
So we have FHA where you can qualify using bank statements.
Shut up.
Yeah. So for
So
self
tell us
so
what the difference is from
sure.
how it is now
Okay.
versus what we got coming down the pike.
Well, yeah, coming down the pike. So FHA is a government backed program where you can put 3.5% down. Right. I actually have a grant program where you can put zero money down and they'll give you the 3.5% and it's forgivable day one. It's
Wait, say that all again.
so all right. So the FHA typically it's a first time home buyer, but it doesn't have to be. You have to live in the property. And that's the FHA. They offer pretty low rates and you can put 3.5% down.
And you can have like your credit score doesn't have to be
Correct.
amazing, so you
Correct.
can actually get in with
Right.
the lower
You can go down to
credit
580. Yeah, 580.
580. And I think
And
that
even
some
lower than that even lower than that if you put 10% down. However, if you're out there and you're thinking about buying a house and you have less than 580 credit, I would work on your credit first. We
but
don't want to put
this is
anyone in
the
a
thing is
situation where they're gonna,
of course,
yeah,
yeah, like get it together.
right,
But also I feel like there's no excuses to like not buy real estate and to not like start investing, because I think a lot of people that were like, oh, my credit, or my I can't find any money, or like whatever it is.
right,
I just want to encourage people.
yeah. I mean, if your credit's 450, work on your credit first, but you should
Yeah.
be working on your credit, like,
Yeah.
and you should be thinking about it daily. And if you don't
But it's
if you don't own if you don't own your house, and for some people the bar is insurmountable. Everyone has different situations, but it should be a goal. It should be a goal because home ownership is the number one vehicle for upward mobility socioeconomically,
so
right? So it's the biggest creator of middle class people.
but I was listening to Bigger Pockets the other
Sure.
day, and he was like, because of the explosion of AI,
Yeah.
that Rich Dad Poor Dad, this
Robert Kiyosaki, yeah.
vehicle, this vehicle of wealth is only going to be realistically possible for the next like 5 to 10 years, and after that, we don't know what it's going to look like. Which I don't know, but I was like,
So
it's kind of interesting.
yeah.
I'm like, I don't know if I believe him or not. However, I should just do it. I should just buy more. Like I have my friend who I went to go listen to. I was talking about this the other day, but my friend Jen Mello, she hosts
Yeah.
a women's group, and it's called Accomplish Her. And she actually had one of the panels that she had the men, like women were able to invite like their husbands, and the
Sure.
men were able to come, and so they had a whole investors panel come
Mhm.
on and talk about people and how like what investments these people had made.
Sure.
So one of the girls came on, Allison Sabak. She's a single woman,
Yeah. You're pretty young too, right? Like in her
pretty
30s,
young,
30s?
yeah,
Yep.
30s, maybe almost 30s. And she's like, yeah, I've bought a multi-unit and I've flipped a house pretty much for the last 10 years.
Good for her. That's great.
And I was like, I was like, that's an amazing goal.
Yeah.
And I never like thought of it.
Hmm.
I know that sounds stupid.
Well, no, but in fairness, the background on the woman that Megan's talking about, her mom owns a mortgage company and does do private money, and they've been in real estate forever. So
But her
she
mom taught her
right,
to buy
right,
multi-units.
right. So it's not like she came out of the blue and she woke up one day and she's like, I'm going to buy a multi every.
Yeah, but how did
But
her mom learn?
sure, so someone learned down the road.
Down the
But
road.
and that's why, to your point, get started now, because this is information you could pass down to your kids. I'm creating. I have an 8-year-old, and I'm creating wealth for him, and part of that is, so there's obviously investments and whatever, where compound interest, he's going to have millions of dollars by the time he's my age, right? But and only
Thanks, Dad.
yeah, and I'm only putting like $200 a month away, and he'll have, based on 10% return when he's my age, he'll have $5 million in the bank or in mutual fund, right? Um, and you can create generational wealth for your children with not a lot of money out of pocket. Same thing with investment properties, right? So if you're teaching your kids these things, it's important for them to learn, because they're not learning in school. I never learned it in school, right? And
No idea.
yeah, no idea. Um,
Just about even basic like accounting and
right, like how to balance a
seriously.
checkbook, right?
Yeah, like, oh, I
Right.
gotta pay. They never teach you like, oh, by the way, 30% to the government.
Yeah,
For what?
right.
Still wondering.
No one knows. Yeah, I think ballroom maybe.
Bombs.
Yeah, bombs and ballrooms. So the um so FHA,
Okay.
right? Back to FHA.
Yeah.
So a lot of people will do what's called house hacking, right? So they'll buy a 4-unit with 3.5% down. They'll live in it for a year or two, and then they'll buy a 3-unit that they'll live in with 3.5% down. And they'll acquire multi-family properties a lot, through this house hacking thing where they're putting the minimum amount down. They're using FHA. It's difficult for self-employed borrowers to do this because they look at 2-year tax returns, and
So and it's an average.
it's an average
of the
unless your income goes down year over year, and then they use the lower of the 2 years,
Yeah.
if it's the most recent year. And if it's going down more than 25%, it's a manual underwrite, and you actually it's more scrutinized than if you just had W-2, right? Now, the product that's coming down the pike is bank statement loan. And what that means is they're going to look at 24 months bank statements. And for self-employed people, right, you have cash flow coming in. And it's not looking at your deductions, which if we use a tax return loan, you're going to be hit with all those deductions, right? It's the net number that they use. And you can add back some stuff like depreciation and some other stuff. But for the most part, you're using the net number. So your number here that you make, say you make 300,000, you have a really good accountant, and somehow you end up netting 40,000 in taxable income. FHA is using that 40,000 number to qualify you, and everyone knows it's very difficult 40,000 to buy anything. So what the new product that's coming down the pike is a bank statement loan. So if you have that cash flow coming in for your business, we'll look at that, right? And it doesn't look at
$300,000.
it doesn't look at the deductions, right? So we're using pretty close to that $300,000 number, correct? So that's going to be a game changer for self-employed people who want to do this house hacking.
So, okay, I feel like there's a lot of misnomers around the house hacking
Sure.
and the FHA.
Sure.
Um,
Yes,
So
because there's a
let's-
fine line between house hacking and mortgage fraud, right?
right.
Yeah,
Right.
right. So you do want to live in the property.
Yeah,
you have to live in the property.
Yes. So we do. So nobody commits mortgage fraud. I don't mean house hacking like that. I mean, you buy a 4-unit. How long before you can go and move? Like, are you able to go and do an FHA loan, do an own your occupant, and then within a year say, you typically need to say like, I need a bigger space for my kid, or like, what is it? What's your
Sure. So yes, those are all.
so
They,
from,
you
can you
have
go
to.
from can you go from 4 to 3 and then to 1?
So there has to be a reason that makes sense, quote unquote, makes sense to an underwriter, right?
Right.
And those
you need
things.
more space, right?
So those
that's
things are
one
like, oh, you
thing.
have kids, I need more space. I just got married, need more space. The house I live in is on a busy street, and I'm moving to a more rural or suburban area.
Okay.
better school system,
Mm,
closer to work.
right.
But moving from
It has to be
4
like an
units,
hour, right?
uh,
There's like, isn't there like a radius?
so the radius, you can't be more than like an hour and a half from where you live to work for FHA too. It's like, I think it's like 60 miles or something like that. Um,
Oh, interesting. No, I was saying more like the radius in terms of like,
if you know, if you're going to move closer to work, it just has to be closer to work.
okay,
So,
got
but
it.
there is a distance requirement for you. You can't work in Maine and say you're going to buy a multifamily in Rhode Island. You know what I mean?
Right.
Yeah, it
Okay.
has to be
Mortgage
close.
fraud.
Yeah, right, right. So one of the reasons for an underwriting approvable reason for moving from one property to the other is I no longer want to live in a 4 unit. 3 units are fewer units. So 4 to 3, right there is a makes sense for an underwriter, right? 3 to 2, 2 to 1. You can't go from a 1 unit to a 4 unit.
Well, and that's
That doesn't
why,
make sense. So you have to start, yeah,
but that's why I always tell my clients to start off with a multi-unit
right,
because that's the way that they're going to be able to get into a multifamily for
yeah,
the least money down versus if you do it the other way, you do the single family with 3.5% down, then you buy the multi, you're in there for
right,
25% down for the multi-unit.
right. And you do want to try to refinance from an FHA to a conventional mortgage before you move into the new house. So you're able to access owner occupied rates on the conventional because technically you're
Owner
only supposed to have
occupied
one.
rates on the conventional. Oh, so
Right.
you're saying
So saying you have a plan, right? You're like you're this woman and you have a 10-year plan where I'm gonna buy a 4 unit, 3 unit, 2 unit, 1 unit.
can you do all that though? People say that you can't.
You can. Yeah.
Okay.
Um, but while you're still living in the 4 unit, you want to refinance into a conventional loan. So then you're only supposed to have one FHA at a time.
Yeah.
And there are loopholes and there are exceptions, but for the most part, you want to make sure you're refinancing out of the FHA into the conventional before you move out of it because there's a huge difference between owner occupied rates and investment rates. So it's usually at least a point in interest rate. So again, if this is something that you're going to keep and collect income on, you want to make sure your fixed rates, your fixed costs are as low as possible, and you're able to figure that out.
So you go from the 4 family to the 3 family, um, and then you can just keep doing that. And like, what's the minimum amount of time? Like, is there like, isn't there a time limit? It's usually
So
like a year.
yeah, typically it's a year,
But
but
but if you get a new job,
right. So there are life happens,
reasons.
right?
Yeah.
I there was a woman that I helped who bought a house using FHA and then never lived in it. And it was because she got a new job and she actually lived somewhere else. So, she bought the house and she was going to stay in her apartment till whatever, and she was having some work done on the place, and then she got a new job and she ended up moving to a different state, and she kept the FHA mortgage and then bought something else. Um, which is allowed because again she's moving out of state where um it's closer to her job, right? The property she had, and again, this is a one-off situation. This is not
Right.
typical.
Right.
And again, if you're out there thinking of ways to game the system, just don't. It's just like there's so many ways to work within the system to
Yeah.
get what you want. It's not worth it because there's a list of people, and you go on the blacklist, and you can't get financing anywhere. That's not true. I just made that up, but there should be, and maybe we should get one.
Um. All right, cool. So basically, you can get an FHA loan with bank statements,
That's coming down
which
the
is
pike.
great.
It's not active yet, but
And
yes.
there is something though too for people who are self-employed like myself,
Right.
not FHA but conventional, because sometimes there was a time
Yep.
where I did not make a ton of money one year,
Hmm.
and I was worried because I was like, they're gonna average the two. My average is gonna be
Sure.
super low. However, conventional, they were only gonna look at 1 year. My last year,
if you've
if I've been in business for 8 years or
said
up to
5, it's 5 years.
5 years.
So, but here's the thing,
Okay.
because there's wrinkles to this too.
Okay.
if you're self-employed for 5 years and it has to be the same entity.
Right.
So you can't go from like Meg Hayden LLC to Meg Hayden Incorporated within that 5 years because it resets the clock.
Got it. Yeah. So you have to maintain the same entity
Right.
that you're doing your tax returns
Right.
under.
And here's the other thing.
Yeah.
It has to tell you that's allowed in the automated underwriting findings. Typically, Freddie Mac is a little bit better with this. You typically get those findings regardless. But if you are not putting a lot of money down or your credit score is not great, you could potentially still get, because again, mortgages are risk based. They're trying
Right.
to
They're just trying to
yes,
like level out.
they're
And
trying to
see,
mitigate the
like, they're
risk.
like,
Yeah,
do we really want to loan to you?
correct. So sometimes they're going to want to see a track record.
Okay.
But you're right. So self-employed people typically, but again, even non-FHA, there's bank statement loans available right now.
Right.
There's a guy I'm working with. He just started an ice cream company,
Cool.
and like started last year. It's going gangbusters, but he doesn't have the tax returns to show it. But but the income is coming in, right? And
Right,
we
you
have
see
business
it.
bank statements, right? So we're gonna use a bank statement
So
loan.
like
And,
when
yeah,
you say a bank statement loan, so you're
Mhm.
looking at the bank statement, you're looking at like what the end amount is.
we're looking at
Correct. Not like what came in, but also like what came out and
so
how does that
we're looking at what comes in more than what goes out. Um, if what goes out is a business expense, it may get subtracted. But if you're like buying pizza for your family or groceries, whatever, that doesn't typically get um, uh, subtracted. So they're looking at business transactions.
Okay.
Yeah. You look very pensive.
I know, but I'm like, well, I mean, if you have two separate bank accounts, right? One for your
Right.
like,
So if you run
personal-
if it's your business, if you only have a business account,
Yeah.
then it's probably going to be the number at the bottom.
Yeah. Okay, but then but you can still do bank statement
But they
loans
average it
with-
over the 12 months. So
with regular people,
correct.
right?
Yeah. Yeah. It makes more sense for self-employed people because with people who are salaried, right, we're using that gross number. So it doesn't make sense a lot of times for people to use bank statements unless they have like crypto or something like where they're like, they're taking money from some other place and it's hard to explain on a conventional mortgage underwriting guideline,
Okay. My last couple. Do you have anything else you want to talk about? I have like my last couple questions, but
So just, the fact that, again, being here a year later and having learned so much about just the wholesale channel, basically being a mortgage broker, it just seems like for people out there that are kind of hesitant to use a broker, just talk to me or talk to someone else. Because again, you can tell me what you're trying to do, and odds are there's a program that's going to help
I'll
you.
go find it.
Yeah, right. And whether that, I mean, there's profit and loss statement programs. I had someone who didn't qualify based on their bank statements, but their accountant wrote the profit and loss for them, and they did qualify because the profit and loss looked better than the bank statements. Which I'm not an accountant, so I don't really know how that worked, but it did. And it's everything. There's, if it's more than 4 units, you got 5, 8, 10 units. We're able to if it can be financed, there's a lender out there that I have access to that can finance it. And even when I was talking about before that we got mentioned to talk about, there's mortgage grants for FHA. There's first time home. You don't have to be a first time home buyer. So it's a down payment assistance grant, and you don't have to be a first time home buyer. You don't have to make 80% of the area median income. You can basically, you just want to buy a house and you need a down payment. This is helpful, right? You really need a seller who's going to offer seller concessions on it, because
Which most are
Yeah.
doing it now.
Right. So-
I mean, you are like you're seeing that.
yeah.
And seller concession means basically like your closing costs, your
Right.
prepaids, your
Right.
escrows.
Right.
So typically, I don't know, for like a $500,000 house, you're going to figure anywhere from like $12,000 to $15,000 for closing
Right.
costs. So you're going to have to ask, hey, seller, we're offering $500,000 with a $15,000 seller concession.
Right.
But again, the market is changing.
Right. Well, it is.
Even right now in this hotness that we're in,
It is.
but it is actually changing, and everything's a lot of agents that I've been talking to, their listings are slow. And we are in May, but I honestly feel like it's going to pick up in the next couple weeks just because I'm going to tell you this.
Okay.
Women buy houses. Okay. They're usually the decision makers, whether
Sure.
they're buying the house or
Yeah.
they're buying it with their spouse. We have so much going on in May. Do you know how many like spirit weeks and
Yes.
graduations
Right.
and baby showers and
Yeah.
that's why I just think like this May is like very slow for everybody, but that's just
Yeah.
my
An
personal
agent I
opinion.
spoke with yesterday described it as Maycember. Maycember, because it's in December you have like a party every week or whatever. Yeah, or like a lot of things going on because of Christmas and stuff. But yeah, so I would say I do agree. Women buy houses, and single women buy more houses than single men.
Whoop, whoop.
So there's
Myself
that.
included.
But I would say here's the other thing. Temper expectations, because as this war goes on in Iran, rates continue to go up. Rates are the highest now. They're higher. The highest they've been in the last 3 years right now.
Really?
Yeah, like as we speak, the 10-year Treasury bond is up like 70 basis points. Rates are kind of ticking towards 7% again. And what that means for sellers, right, is you're not going to have as many buyers,
Qualified
but it only takes
buyers.
one. Right, it only takes one.
Oh, that's what I always say to everybody. I'm like, we just need
Yeah.
one.
And for buyers, what I'd say is less competition is going to get you a better deal. And if you have the ability to buy with rates, being higher, you can probably get a better deal on the house. You're not going over ask as much, or
No.
maybe not at all.
Or have them buy down the rate.
Right. Or you can have, so that's the other thing.
You're welcome.
As a broker-
This is why
As a broker,
I'm the
I'm
best.
offering people 1 point buy down for the first year for free. So you don't need to get seller concessions for it. You don't need to get any kind of concession for
I'm
it.
going to TJ.
Yeah, so it's
But
it's
what
a
does
free.
but what does that mean, right? So like I think a
Right.
lot of people need to understand.
So-
So when you buy down a rate,
Right.
you go to the seller, and I did that one time
Yeah.
for a new construction property that my
Right.
clients were buying, and I used it as a negotiating tactic.
Mm-hmm.
I was like, listen, you don't have your CO yet. We're supposed to close today or whatever, next week, and then we're not near it.
Yeah.
So I'm like, so you're gonna give us X amount of dollars to buy down the rate. I think I got an entire point.
Yeah, well, that's
Not
it goes
in a
in,
point, but like a whole
It goes in
point
point
off
increments.
of, yeah.
So
So explain that, but it's a really good negotiating tactic when
Yeah.
you're talking to the sellers. It's gonna lower your rate for the next 30 years, which is
no 1 year, 1 year.
okay.
So,
But I'm saying
buy
when
down.
I was negotiating
Okay.
it for my people,
Yeah.
right? Because it's not, if I negotiated a buy down rate, they give money and then it buys down the rate,
So yeah, so there's
which
two
is what
different
I
things.
did. Yeah, but
Yeah.
it's a really great way to negotiate with a seller or with a builder who is not getting their stuff done
Right.
on time.
Right.
Sorry, builders, but I did do that.
Yeah, I've never met a builder that's ever got a CO on the closing date. It's always after. So one oh, it's called a 1-0 buy down, and what it is you get a point less than the current market interest rate. So, say rates right now are 6.5. For the first year, you'd have 5.5, and what it typically you'd have to get a concession from the lender or the seller. You can't pay it yourself. They don't allow the borrower to pay it themselves.
Really?
Right. So
Why?
I don't know. I'm sure there's some kind of compliance situation, but more times than not, it's the seller, because there's repairs, whatever. They're giving them a credit, and we use it towards a 1-0 or 2-1 buy down. And what it is they're just basically paying the difference in interest between 6.5 and 5.5. So whatever that payment is, the difference in payment per month, they buy that out. For buyers for the next like 45 days, we're offering a free rate buy down for the 1 year. So no one has to come up with any money. We're just doing it. And it's something to
Smart.
help buyers, yeah. And just get back it, and get into the market. And for buyers who are kind of on the fence, right? As rates go up, you're going to have less competition. You're probably going to be able to get the house for a better price. And at the end of the day, really where you make your money or lose your money is your entry point, right? It's not, rates can change, you can refinance, but it really is, you can buy a house for less than ask or even at ask. You're winning.
What do you mean? Then it's worth.
Yeah, you're winning. Yeah, right. You're winning.
And that's why, as an agent, you always make sure you put in there. And I don't understand why agents don't do this, but I get purchase and sales agreements where they don't put property to appraise at or above the value.
Yeah.
I'm like, that's just step one in writing up a.
I think someone
purchase
told me
and
it's in the boilerplate, but I have not found it. Someone told me it's in the boilerplate.
There's no boilerplate. You have to write
let's say the boilerplate is like the contract, right? I've never found it, but that's
no,
what
it's not. It's the boiler. I mean, like I have a transaction coordinator, and I tell her this is always what I want in my contracts. Like
Makes sense.
this is Meg's boilerplate.
Sure.
But yeah,
it makes sense.
Okay, so I feel like we covered a lot. What was the last thing you were just talking about?
I was talking about
Oh wait, but the other thing too was with the 0% down. So typically with those kinds of grants, you're supposed to either it's a lien on the property a lot of times, or you need to like live there for whatever 3 years, 5 years, 10 years, whatever it is.
Right.
But
these are forgivable day one.
Okay.
So and the reason that's good is they're FHA products. FHA offers a streamlined refinance. But for a lot of these Rhode Island housing grants or like it sits in second position, and it has to be paid off when you refinance. So you can't use a streamlined refi. So the grant program, right, the grant that we offer, it's for the entire 3.5%, right? So as long, like if it's a $600,000 house, that's like $20,000. So it's a grant. It's forgivable day one.
Yeah.
And you just have to basically have it for 6 months, and then you can because FHA makes you hold a mortgage for 6 months before you refinance. Then you can if you qualify or need to, if it makes sense, do a streamlined refinance because there's no second position lien in place, and you're allowed to just do a streamline and lower the rate.
Streamline refinance.
That means you don't need an appraisal. You don't put any income on it. It's true streamline. So
there's just one position.
Correct.
There's not a second position.
Correct. So a lot of these like Rhode Island housing or down payment assistance, they're not truly grants. They're mortgages you don't pay back until you sell or refi, and the streamline doesn't work if there's a second position lien.
Right.
Yeah.
And that's like one of the things too when you are, I mean, these programs are great and you just have to know like what you're getting.
Right.
And whether you have to pay it back.
Right.
There's other programs that you have to pay like a little bit of interest on, or it's a secondary lien.
Sure. Right.
And so when you go to sell the property, you have to remember that you got this loan.
Yeah.
Because when I come to do the net sheet with you, which is calculating exactly how much you're going to walk away with.
Yeah.
If you forget that line item of $10,000, $15,000, $20,000,
it's net less $15,000 less. That's a lot.
It's gonna make a big difference in your next purchase, and thinking you're gonna have more to come to the table with, and you don't. All right, so we covered so much, but technology, is there any technology that you're like leveraging, using?
So the biggest thing really is we have access to a platform called Pylon, which is direct to Wall Street lending. So we're the only broker. There's one broker in California that's only in California that has it, but we're the only broker besides them that has it. National broker. We're licensed in all 50 states, and basically what it is it's really raw pricing. There's no one's taking any of it, and it's direct to Wall Street, where this is really for salaried employee who has very good credit, but they're going to have access to the best rates possible. I got someone rate in the 5s yesterday, where rates are really in the mid 6s right now in most situations, but because they qualified, based on their credit and the fact that they were, W-2 employee. The rate was in the fives. They're going to have better rates than anyone else. And again, that was my point. Like if rates are high right now, right, prices of houses are high right now, why would you work with a lender that has higher rates? It doesn't make sense. If you're out there shopping, or even, if you're a real estate agent, you're really doing a disservice to your client by not talking to someone who's a broker. It doesn't necessarily have to be me. Just talk to someone else who has a broker. I mean, I think I work for the biggest brokerage
I
around.
feel like just in general, like in life,
Yeah.
you should have at least like 3 people that you
Sure.
talk to.
Yeah.
So it's like
And the 3 people should not include like your uncle who bought a house in the 80s.
No. I'm talking about like
Yeah.
lenders,
Yeah.
mortgage brokers, or like whatever. Like for instance, and that's very important.
Yeah.
So that's cool. So that's the type of technology that you guys are using.
I mean, it's kind of the biggest one that stands out, where it's just, I mean, it really is it looks like an AI platform. You plug in all the information, and they use AI to actually qualify the borrower, where they're pulling stuff from the internet, like instead of pay stubs, and it's all AI generated.
Pulling?
What?
What's it pulling?
So you put in your information, your social, whatever. They'll pull, using the work number, whatever. They'll pull your W-2 for you. They'll pull your bank statements and stuff if you need them, and it's all done online and through AI, and then there's qualifying based on AI.
Crazy.
Yeah.
Any book or podcast that you're listening to that you like, interested in? You're like, oh,
I just read a book that's kind of out of character for me, called Strangers. It was written by a woman who like got divorced from her husband. She found out like one day her husband was cheating on her, but like the author is somewhat local. I think she's a woman. I can't forget her name. It's like her name is Belle something. But really good book. Other than that, I read a book called The Coffee Bean. It's super fast. If you guys are looking for like something to read at the beach where you can get done in like 20 minutes, not even, read The Coffee Bean. It's a really inspirational story. And basically, I'll tell you right now, guy was a really good football player. He got hooked on drugs, ended up going to prison for like burglary he got sentenced for 65 years. And before he went into prison, he was talking to this guy who was also going into prison. And he's like, prison's like and this is true of life too. You could say life is like a vat of boiling water, right? Mm-hmm. And you can be a carrot, or you can be an egg, or you can be a coffee bean. Carrots, when they get put in boiling water, right, they get mushy, right, and they don't stand up. Egg has a hard shell, but then the inside becomes hard, so your heart, that's a metaphor for your heart becoming hard. So you become mushy, you could become a hard person, or you could become a coffee bean. And when you put a coffee bean in a pot of boiling water, the whole pot becomes coffee, right? So any situation you're in, you pour into other people, right? You lead with love and compassion, and really just try to add value to whatever situation you're in. And so that really, I saw this guy speak in Chicago a few weeks ago, and it really stuck with me. And I've tried to, it's one of those things where you're like, oh my gosh, it's such a simple thing to do, but it makes such a difference in your own mindset. And then it makes such an indelible mark on the people you come across every day as well. If you come into every room and you try to be a coffee bean, and you try to, make the situation better.
Well, that's what we were talking about the other day, and I just love that you had mentioned that that you try to fill the room with love.
Yeah.
And I think that is something that we all need to do more of, and just realize like the expansiveness of us, and the energy that we give, and the abundance that we have, and that walking in. And it's funny because I listen to a lot of like meditations and stuff like that, and a lot of times like Neville Goddard, and he talks about like being God. And I know that like maybe that sounds a little ridiculous, but being God or being Jesus in every situation, which is just being love, being forgiving, being kind, like be God, even when it's really tough, even when you don't
Yeah.
You're like, no, if I were more like God, how would I be? If I were more like Jesus, how would I be?
It's even like the bracelets. What would Jesus do bracelets, right?
Yeah, I mean, and
Yeah.
again, I'm not super religious, but I just think that that we all need to be more love.
I think again, this is my own personal stuff. We're getting weird tangent, but I will share. Love was such a word. Like growing up, it was kind of a taboo word. Like it was like save this for people that you're, in love with or whatever. And like
you couldn't share it.
yeah, no, like
It's
it was
something to hold on to.
it was like pie. You ran out when the last piece got served, like the last slice of love. But like love is something that's kind of infinite, and it's a optimism and a mindset. And I don't mean I want to like make love to every person in the room. It's more like, hey, I'm gonna come in. I'm gonna see if there's something I can help and fix or just try to be present for whatever
the reverberation of the thing.
Right. It's just an attitude.
Yeah. And it's funny because I just went to go pick up all the stuff from the sisterhood swap that I do, and it's this pop-up community closet, and everything in there is free. I just didn't want it to be. I feel like a lot of everything that we do now that's very transactional.
Yeah.
And I don't like that. Like it's like, okay, if I do this for you, then you're going to do this for me, right? Versus just being the reverberation of it all. But it was so cool. Like the lady today, she was like, she's like, I took some stuff because I work somewhere. I work at the Warwick Mall, but I'm actually going to give the clothes to one of the guys that I work with, his kids, because I just always see them in sweatpants, like pajama pants.
That's super nice.
She's like, but Christmas. So I'm like, how cool is it that just the thing that we have is allowing this woman who doesn't have a ton of money to be able to give to somebody and I'm like, it's just like, oh, I'm like, oh, cool. So it goes from us to this person to that person, and it just ripples out.
Right.
So I guess TJ's mantra is be more. What's your mantra then? Be more love. Walk into that. I mean, I think you said it.
I think part of it is just being more vulnerable, being more open, saying yes to things that help people and no to things that maybe are harmful to myself.
Yeah.
So again, I a lot of times, again, we're getting deep here, but I approach a lot of things where if I'm only harming myself and I'm not hurting anyone else, what does it matter? With drinking or whatever, it's like or eating stupid things, whatever it is, right?
The fundamental, this is not good for me.
Right. Not
period.
Right.
In general, we know this.
Things are not good for me, but I'm like, it's not hurting anyone else besides myself. Maybe stop that and channel that energy into helping people that that need the help. And I think it's like, have you ever when you go and you volunteer for something and you feel really good, you get this really great feeling.
Yeah.
Right. It's like that, right? And if you can approach every situation in every
day,
room,
dude. You could do that every single day. You could do give the person behind me the free cup of coffee. Here's $5 or $3, or whatever it is, or just even telling somebody that they have a nice shirt. But I'm really kind of focused on the fact that I think that every single person should, with their family, with their child, should be volunteering 2 hours a month.
Yeah.
Wherever. There's the Providence Bread where they give out bread every Friday to homeless people.
Yeah.
And not just being like, oh, Christmas time, I'm going to go help people. It's like people are hungry all the time. People are, they need clothes, they need help, they need support. Yeah. And so do the nonprofits. And so I think it's really I know I commit quarterly doing the sisterhood swap, but I really encourage people to do more for the community, to show up and to also show our kids what it looks like to take care of everyone else. And so if you're sad, if you're anxious, if the doctors are putting you on medication, I'm like, go help someone. I swear to God, you're going to feel better. I promise you that hour of watching television or scrolling on Instagram could literally just be reverted to doing something good for somebody else.
Yeah.
So how can people get in touch with you?
They can call me 401-258-8523. They could reach me on my website, tjcurran.com. I'm on Instagram, TJ Go Rascal, I think it is. I'm going to switch. I'm starting a YouTube page too. It's called The Mortgage Unk, because I'm older for someone that has an 8-year-old son, and my son started referring to me as an unk, which I guess for the kids it means like an old dude. So I'm gonna lean into that, and I'm gonna start
Yeah.
a page called Mortgage Unk, where I'm gonna offer mortgage advice on this thing. So
I love it.
yeah,
There
yeah,
we go. Mortgage junk.
Mortgage Unk.
All right. Well, that is it for today's episode. I want to thank you so much, TJ, for coming on the show.
Thanks for having me.
Of course. And that is it for today's episode of The Landlady Listens, where we turn vision into reality. Remember that success starts in your mind before it ever shows up in your life. Keep believing, keep building, and most importantly, keep taking action. Until next time, trust the process, bet on yourself, and go create the life that you deserve. And don't forget to like, subscribe, and share this episode with someone who needs to hear it. Thanks, guys. Love you. Bye. That's it for today's episode of The Landlady, where we turn your vision into a reality. Remember, success starts in your mind before it ever shows up in your life. Keep believing, keep building, and more importantly, keep taking action. And until next time, trust the process, bet on yourself, and go create the life that you deserve. Don't forget to like, subscribe, and share this episode with someone who needs to hear it. Love you.